This instruction video is intended to give you a little bit of information about the stock market and ways that you can improve your ability to earn a better income through investing in stocks, bonds, or mutual funds. So Stock Up for the Future is this little presentation. Objectives that we have excuse me, for the presentation. Number one, to discuss the reasons for trading stocks. And objective B is to explain the different types of stocks available to investors. So let's look at reasons for trading stocks. What a stock is actually ownership in a corporation. When you invest in a stock, you're buying a piece of the company. And when you invest your money in that company, you're buying shares of stock or shares of ownership. And those shares that you're buying are issued by the corporation. And the very first time they do that, it's for the purpose of raising money. The initial public offering, or IPO, is the very first time that shares in a company become public to investors to buy. Now, most of you will probably never participate in an IPO. To be honest, I've participated in one my entire life. Could have participated in two, but chose not to. But what happens in an IPO is that a group of investors have the opportunity to invest their money first, prior to anyone else having the opportunity to put their money into that company. Depending on the circumstances in the case, the individual investor that buys the IPO might be able to get on the ground floor of an opportunity. But there's also a certain amount of risk that goes along with that because the company has no history, has no tracking that you can follow because it hasn't traded public in the market. So the IPO is a little bit more risky from that standpoint. The benefit that the company has from an IPO is that they get to keep all the money that's raised by that initial public offering. So for example, when Twitter became a publicly traded company, they had gone out and sold shares to the public. Okay, so continuing on with the presentation, my phone rang and I put this on pause and I totally lost track of exactly where I was. So let me go back. I think we were talking about the initial public offering and the fact that the company gets to keep all the money. So when Twitter became a publicly traded company, all of the money that was raised from the initial IPO went directly to Twitter. Okay, so if they sold 1 million shares, and they sold it at $10 a share, they get $10 million. All right. What happens then is that anybody that wants to buy that stock after the initial public offering has to buy it in something called the secondary market. Okay, so that's a place where investors can trade securities back and forth between each other that are issued by the corporation. But the difference is that when you trade stock in the secondary market, the profit made is kept by the seller of the security. So let's say that I bought some shares on the IPO, and let's say those shares went up $10 or $20 a share, and I decided that I wanted to sell some of my shares. And let's assume that you were a buyer and wanted to buy some of those shares. Well, through a stockbroker, we could make that exchange, all right, and that's called the stock market or a stock trade in the secondary market. So the secondary market is where probably 99% of any trading that you do will actually be done. So if I sell you my shares, the profit that I made from when I purchased it to when I sold it, that goes into my pocket. Twitter has no benefit, receives no money from the sale of a stock after the initial public offering. In the secondary market, it's just money that's exchanged between a buyer and a seller. Now, the way the stock market works, it's a little confusing because the market is guaranteeing that for every buyer, there is a seller. And for every seller, there is a buyer. And it's just the way the market works. These brokerage firms who participate in trading securities have to guarantee that they will be able to execute the transaction. If that means they have to sell shares that they own, they will. If it means they have to buy shares with their own money to keep their clients happy, that's what they have to do. But it's all based on the market price. So why invest in stock? Well, the primary reason is for capital appreciation. People buy stock because they buy it today with the anticipation that when they sell it, it's going to be worth more money. So your price appreciation, or the value of your stock, accelerates, and that's called capital appreciation. When the price goes up, that's called price appreciation. So a company, if they do well, they'll take the money that they earn and they will invest it back into their company to make their corporation more valuable. Therefore, will attract more investors. As more investors are attracted to it, they continue to improve and sell more of their products. The price of their stock increases and the value of their corporation increases. Now you got to remember that when you invest in stock, there's no guarantee. Okay, not every company makes money, and you're not guaranteed that you're going to make money in a company either. That's why it's important that you research and read information about the company that you're about to invest in before you make that investment. Another reason that people buy stock is because of dividends. A lot of companies will pay dividends. Now think of dividends as like interest that you receive on your savings account in a bank. They pay you a portion of their earnings just for owning the stock. Okay, it's not a legal requirement, but they are generally paid in cash to the shareholder. Dividends are paid 4 times a year by most companies. So every 3 months, okay, every quarter, a company will distribute a portion of its dividends if it's a company that pays dividends. Typically, companies that are called blue chip companies, those are some of the large, more successful companies that trade in the market. Those are typically the ones that pay dividends. Some of the smaller startup companies that haven't really been established for a long period of time, well, they don't pay dividends. They keep the profit that they earn and they reinvest it in their corporation to try to make the company itself more valuable, and maybe with the plan down the road to distribute income in the form of a dividend. When you buy a stock, you can't just buy it from anybody off the street. You need to buy it from a licensed stockbroker. So a stockbroker is a licensed agent. They have to pass a relatively difficult test called a Series 7. It's about a 6-hour exam that you have to take that verifies that you are certified to sell these securities. And you have to be employed by a company that's registered with the Securities and Exchange Commission. Okay? So buying a stock has to go through a legal registered representative. You and I can't just sit down and make that kind of an exchange. Stock exchanges themselves, well, when we talk about a stock exchange, it could be a physical location or it could be a virtual trading place. Okay? The picture that you see on the screen is a sample of what the floor of the New York Stock Exchange, or the NYSE, looks like. The NYSE is a physical location on Wall Street in New York City, and it is the location of the largest stock exchange in the world. Okay, you'll notice a bunch of people running around in that picture. You'll see a bunch of screens. Okay, there's some trading locations called kiosks that are occupied by brokers, floor brokers, and other registered representatives. If a stock is a member of the New York Stock Exchange, that's where that particular stock might be traded. Now, if a stock is listed on the NASDAQ, which stands for the National Association of Securities Dealers Automated Quotations, the NASDAQ system is a virtual system. It's an electronic way of trading. It is not a physical location where stocks are traded. And so what that means is that it is all computerized. It's a huge computer room that houses many, many computers that tie all of the stocks traded on NASDAQ into the trading system. And there's probably about 6,000 companies traded in the NASDAQ. There's probably around 1,700 that are traded on the New York Stock Exchange. But the exchanges themselves, we still refer to them as an exchange, even though one is a virtual and one is a physical location of where it's traded. So what makes these stocks go up and down? What drives the price of a stock? And the key word to that is demand. Demand drives the price. If there's an increased demand by an investor in a stock, the price is going to go up. If there's a decreased demand, if people don't like the company, then the stock price is going to go down. Okay? So what drives price? Demand drives the price of that stock. So let's talk for a moment about some different types of stock. All right. Stocks can be categorized in a number of different ways, but one term that you'll hear is buying common stock. Common stock is just the basic shares of ownership that give the individual investor a voting right. There's another form of a stock called a preferred stock. Preferred stock just means you have preferred status, but you relinquish your opportunity for exercising a voting right. For the most part, I would guess that most of you are going to be buying common stocks. I've never purchased a preferred stock in my life. There's really no distinct benefit to it. As a matter of fact, a lot of companies don't even have preferred shares. Most of them trade just as a common stock. So that's the one that you're going to hear, the most information about when you learn and listen to the stock market is the trading of common stock. Now, stocks vary in size and they vary in their philosophy as far as what kind of growth that they expect. Different stocks trade by market cap, and a market cap defines a number of different ways. It can be defined, but one of the ways you can define it is by the number of sales that it has. So if I'm buying a stock that's considered what I would call a large cap, it has to have 5 billion or above in sales. Okay, there's some that are even classified as a mega cap, which would be from probably 15 billion and above. Those would be super large. Okay, a mid cap would be 400 million to 5 billion in sales, and a small cap would be considered a company that has under 400 million in sales. Now, the reason it's important to know that in investing in the market is that these different cap sizes, they grow at different rates. If I'm going to buy or if I'm going to invest in a stock that's a large cap, well, my expectation for that is going to be about 7% to maybe 10% growth. Okay? If I invest in a mid cap, I'm going to expect about 10 to 15% in growth. And if I invest in a small cap, I'm looking for something that has pretty explosive growth rates of maybe 15%. Okay? So what you want to have as an investor over a period of time is kind of a mixed portfolio of different cap sizes of your stocks. Now, when you buy a company, these companies are classified with different objectives. Okay, you might have a stock that's a growth stock. Their whole goal is to achieve capital appreciation, right? You might have a stock that is considered an income stock, and the whole purpose of buying the income stock is to have higher than average dividends. And you might be looking for a stock classified as a value stock, which means that stock trades at a price that is below its historic average. So it's like buying something that's on sale. And so again, as an investor, having a mix of size companies, you also maybe want to have a mix of investment objectives so that you have some that are growth, some that are income, dividend paying stocks, and maybe some that you're buying on sale that you would consider to be a value stock. So the ideal situation is to buy a valued company that has good growth that also pays a dividend. Now you've kind of covered all of your bases. Again, some other types of stock that you'll sometimes hear about in the market, domestic versus foreign. Okay, domestic would be companies that sell their products at home versus foreign means in the overseas markets. Now, you have to understand that many U.S. companies also do business in foreign countries. So for example, Apple is a domestic company, but their greatest growth is going to be in the foreign markets. It's China. They just signed a deal with China Mobile to distribute their Apple iPhones overseas. So it's a domestic company with foreign exposure. The other thing you have to understand about some stocks is that there are market cycles. And you have to look at the economic responses and how the economy is working. If you buy a company that's considered a cyclical, they go up and down with the economy. So a company like Ford Motor Company, General Motors, maybe a recreational vehicle company like a Polaris or an Arctic Cat, they're cyclical. When the economy is good, they'll do well. But when the economy is bad, they're going to get hammered because people don't want their products, their goods or services, because they can't afford them during a down or a bad market. Defensive companies, on the other hand, are ones that are kind of independent of the economy. They do well because they have a good or a service that people need. All right, so a defensive company might be something like healthcare. Everybody has healthcare needs, whether you're a good economy or a bad economy. So they would be considered defensive. Sometimes even utility companies that provide electric utilities, electric service, we all have to have electricity. So a company that's in the electric business would be considered somewhat of a defensive type of a stock. Some companies are referred to as speculative. These are ones you want to stay away from unless you've got a little bit of money to lose and you want to take a little gamble. But these are issued by companies that are probably not real well established. And you might hear the term penny stocks. My definition of a penny stock is anything that sells for $5 or less. And they're $5 or less for a reason, because they're probably not a real successful company, and there's a greater chance that you could lose your money. Yes, there is a great chance that you could earn money and make money, but more times than not, there's a greater chance on the downside. So we use a stock selection guide to find a company that gives us a 3-to-1 upside potential. You're not going to find many that would pass the test if they're a penny stock, because there's greater downside risk than upside potential with many of these companies. And finally, some things that help you gauge whether it's a good time to be in the market or not are some market indices. The most common that we talk about is called the Dow Jones. And the Dow Jones is an index of 30 companies. They're the 30 largest companies that make up the New York Stock Exchange. It gives us some direction as to where we think the market might go for that particular day. And if the Dow is up, that means the 30 largest industrial companies in the world are having a good day. A better index is maybe the S&P 500, because the S&P are 470 companies in addition to the 30 Dow stocks. And so it gives us a broader index, maybe a bigger picture of what might be happening in the overall market. So it's an index that we sometimes follow. Now, if you look at the average of the Dow and the average of the S&P 500, it's like comparing apples and oranges. So you can't look at the numbers and compare what the number is to the other index, because they're calculated totally different. The same would apply to the NASDAQ. The NASDAQ Composite Index is another one that we take a look at and we evaluate. But you have to understand that the NASDAQ, again, is a little bit different market in its makeup. The Dow has about 1,700 stocks. The Dow Jones has 30 stocks. The S&P 500 has 500. And the NASDAQ is a composite of about 5,000 stocks. Okay, so when we look at those numbers, they're a little bit more difficult to calculate. And also the mathematical formula that's used in calculating them is also difficult to understand as well. What we do is we compare each index to each other from the previous day. So if I compare how the Dow is doing today versus last week, last month, last year, it gives me an index that I can compare how those 30 companies have done. Or the S&P 500 compared to last year. I know that we've had some growth or we've had some decline. And the same with the NASDAQ. Okay, so I hope I've given you a little bit of an overview. This is been going for about 18, 19 minutes here to give you a little bit of an overview of the stock market and a little bit better understanding of it. I think the stock market is probably one of the best places that you have to improve your financial condition if you understand it. If you start at an early age, if you invest regularly, you reinvest dividends, and you start out by buying some conservative companies until you get your feet in there and kind of learn the market, I think it is a great opportunity for you to increase your wealth. So I hope you seriously take a look at it. When you get out and get a full-time job, one of the things you're going to have is an opportunity to invest in a retirement fund, and that retirement fund definitely will give you an opportunity to participate in the stock market, whether it be individual stocks or in mutual funds, which is a professionally managed portfolio of stocks. There's lots of information on the internet that you can go out and find. Probably my favorite source is motleyfool.com. You could go to msn.com or finance.yahoo.com. And if you do any searching for stocks or mutual funds, there's tons of information out there that would give you some good insight into how to increase your savings from a regular passbook savings account to a little bit more aggressive opportunity to grow. So best of luck. Hope you learned something from this, and that's all I have for you today. Thanks.